Give me Tesla. I want Tesla. Everyone wants Tesla. Tesla, NASDAQ TSLA, is among 2020's hottest stocks. The electric car maker's shares are up more than 250% to date. The stock's rise reflects every investor's growing confidence in the company's long-term prospects. But the question still remains. So, is Tesla stock still a buy? Investors are still wondering, is Tesla stock a good buy at this level? Nobody wants to miss out on a potential moneymaker. That's like leaving money on the table. But it's been on a high road for a long time, that it is scary to put your money on the table, because after all is said and done, the market will correct itself, and we might see a huge bearish fallout, and leave some people crying. Or it might correct itself on a new high of probably $5,000, and you find yourself crying and wishing you took a position. Either way, there will be tears. So what should an investor do? Is Tesla still a buy? My answer is wait and see. So basically, no. And I will tell you why soon. Let's value the Tesla stock first. It's helpful for investors to understand exactly what kind of growth is priced into the stock today. For Tesla's market capitalization to rise at an average rate of 10% annually over the next 10 years from its current level, the company would have to have a market cap of about $721 billion 10 years from now. And to achieve that, Tesla would probably need annual net income of around $14 billion to $15 billion. According to the IBD stock checkup tool, it shows that Tesla has a best possible IBD composite rating of 99. The rating means Tesla stock currently outperforms 99% of all stocks in terms of the most important fundamental and technical stock picking criteria. The stock also has a relative strength rating of 99. The rating tracks market leadership. It shows how a stock's price movement over the last 52 weeks measures against that of other stocks. Also, Tesla stock's relative strength line is near record highs. Without saying much, my answer is, I think we should wait and see. Be patient, staying away until the bubble deflates a bit more and the valuations come back down to earth. We all remember Nikola stocks, how the stock was grossly overvalued. A lot of investors believed in that, and Nikola was overvalued, but in less than 2 months, the stock went down by 36.3%. Essentially, both Tesla and Nikola are story stocks. Story stocks aren't valued on the viability of their business models, their growth and profit metrics, or the health of their balance sheets. Because if it was, Tesla would be in deep trouble. Story stocks are valued based on the stories the company tells investors about how great things will be in the future. For example, Tesla's revenue was down 4.9% in the second quarter despite launching the Model Y and the opening of its China Gigafactory. But just look at how many products the company has in development: Cybertruck, semi-truck, Roadster, fully autonomous autopilot, and now, not kidding, Tesla spaceship are all in various stages of research and developments. They sound good, they look good, but just like Nikola, who did not even have a product yet on the market, they are all theoretical and what-ifs, and you are just a bad tweet away from Elon Musk and having a bad day. With Tesla's track record revenue having grown much faster than 27% annually over the last 5 years, you might be considering to buy shares now. But there are some major risks to this consideration. First and foremost, there's a chance that profitability proves to be more futile than Tesla shareholders anticipate. In addition, if Tesla's growth slows significantly toward the end of the next 10-year period, investors may not believe the electric car maker's stock is worth 50 times earnings at the time. And if the stock commands anything less than a price-to-earnings ratio of 50 in 2030 on $14 billion to $15 billion of net income, the stock's return between now and then could be subpar. Also, after soaring 900% over the past 12 months, the automaker's valuation is becoming increasingly difficult to justify. Despite boasting a market capitalization that is closing in on $400 billion, the automaker's trailing 12-month free cash flow is less than $1 billion. And if you recall, I said they need $14 billion to meet up with the expectations for the next decade. Furthermore, while Tesla's vehicle deliveries are growing quickly and are likely to continue rising, the automaker is only expected to deliver 500,000 vehicles this year. Compare that to the approximately 2.5 million vehicles BMW sells annually, despite BMW's market cap being less than $40 billion. So you have to be careful. Again, I'm not against Tesla. If a good opportunity presents itself to buy, I will jump on it. I just think we should wait for the dust to settle to enter again. There are always opportunities in the market. In the stock market, timing is critical. So when you're looking for stocks to buy or sell, it's important to do the fundamental and technical analysis that identifies lower risk entry points that offers solid potential rewards. Being successful with stock is all about sniper entry. But if you decide to take a bullish stand and buy shares now, it will be advisable to be in it for the long haul, concentrating on the company's long-term potential. New vehicle releases are likely to add to Tesla's popularity and broaden its addressable market. Technological advances will have uses in ancillary businesses, driving new profit centers. Expanding production should foster faster growth. The potential in each of these areas is what drives Tesla's value. For long-term investors, none of these short-term moves are important. And you might be right about missing out. Take for instance what happened on Tesla's first day of trading after its IPO. Participants in the initial public offering got to buy the stock for $17 per share. But on the open market, the stock price jumped 40% to close at almost $24 per share. That was a huge difference at the time. Now though, buyers from back then don't see much difference. It doesn't matter whether someone has a profit on their Tesla stock of $1,531 per share or $1,538 per share. Based on the way Tesla stock has traded since its stock split announcement earlier this month, potential investors such as you watching this video may be tempted to think that buying the stock ahead of its split makes the most sense. After all, shares have already risen 35% since the stock split was announced on August 11th. But the reality is that it is impossible to know how Tesla shares will trade leading up to or after the upcoming stock split. Sure, recent excitement in the market for Tesla shares has likely been driven in part by the upcoming stock split. But there is no rational reason for investors to bet on a stock simply because of a stock split, as a stock split does nothing to make Tesla shares more valuable. Put another way, shareholders will have 5 times the shares in their account after the split, but the total value of those shares will equal their combined pre-split value. With all this in mind, investors like you should base any investment decision on their long-term expectations for Tesla's underlying business and the stock's current valuation relative to those views. Therefore, if you believe the stock is worth more than its $393 billion market capitalization at the time of this video, consider buying the shares based on that belief. But don't buy shares based on a speculative bet on how the stock will trade leading up to or following the stock split. It's simply impossible to know how Tesla shares will trade in the coming days. If you are interested in buying Tesla stock, do so based on your long-term view for the automaker's business potential. At the end of the day, it's all based on your goals and projections of what you think the stock will likely be by your given time frame, based on your analysis. And by you, I mean you and your licensed financial or tax advisor. My concern is the huge bullish move. Following such a huge run for Tesla stock, volatility is almost a given in the coming months. We just don't know when. Of course, there's always a chance that Tesla will exceed even investors' highest expectations. Perhaps, for instance, electric cars become more profitable than gas cars everywhere, leading to a much higher net margin. Further, if Tesla's software and driver assist features get significantly better and help the automaker widen its technological lead over competition, the company may be able to earn more money from its vehicle software than the market anticipates. Tesla has a habit of breaking past new milestones often, typically in dramatic fashion. The spectrum of potential outcomes is enormous, but given the wild growth that is priced into Tesla stock today, you may want to hope for the stock to fall in order to help lower the risk of investing in a business that may be priced for perfection. And lastly, always consult with financial advisors before investing in any stock. That is all we have for you today. Thank you for watching. Till next time.